Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill interviews Andrew Ng, a former professor of business and current investment expert at BlackRock, discussing the nuanced application of factor investing in both public and private markets. Andrew shares his journey from academia to industry, emphasizing the integration of data and technology in investment strategies. The conversation explores the critical aspects of factor investing, the democratization of sophisticated investment strategies for individual investors, and the potential for artificial intelligence in enhancing investment models. Listen in.
Andrew Ng, welcome to Educational Alpha.
Thank you. It's great to be here.
You and I had breakfast together in Hudson Yards, I don't know, a month or two ago. Maybe it was closer to the beginning of the year, but of recent vintage. And it reminded me, because obviously I knew of your name given the gravitas, but I said, I've done something with Andrew before. And I don't know if you left the dark side and went to the dark side, but when you were full-time at academia, we were supposed to do an event together through my old firm, Robeco, who has done a lot in factor investing. And I think you were in transition and it never came to be. So we did have that long-awaited union earlier this year. And thank you for being a guest here today.
Real pleasure. Thank you.
Sticking with the normal script for Educational Alpha, I think getting the street cred of the guests up front is always a good place to start. So maybe, Andrew, a little bit on your background.
I was born in Malaysia, and then Malaysia went through some race riots during the 1960s and 70s. And as soon as the White Australia policy, and that was the actual name of a government policy, was lifted, my parents took their family to immigrate to Perth. And that's where I grew up. And growing up, I was the only white kid in class for a very long time. It just made me different. And I really wondered about that and just always questioned what that difference means and does it matter. I was very fortunate that I got terrific education and opportunities. So I did well in school. And then I came to the United States to do a doctorate in financial economics at Stanford University. So I became an academic, and I was at Columbia University for 16 years. And as an academic, I probably did too much advising and consulting, but I've been always very interested in the very practical application of research and worked with a large number of sovereign funds or sovereign pension plans. Notably, over 10 years, I was an advisor to the Norwegian Sovereign Wealth Fund. In 2015, I took a meeting with some people at BlackRock, the late co-president, Charlie Halleck, and always met with different asset managers and investors. And I thought this meeting would be no different. This meeting was supposed to last an hour. It had also the head of strategy at this meeting too. It turned into almost a 3-hour meeting. We were showing different tools that we had built to each other. On the BlackRock side, I got a taste of Aladdin and the trading and risk management system of BlackRock. And there were actually some very technical questions that Charlie Halleck was asking about why certain graphics were being rendered so quickly. And I gave very technical answers, even showed him some of the code base. And I thought, what's a president of a company managing trillions of dollars knowing stuff about actual programming and code? And I realized after that meeting that you need 3 components really for anything to really make a difference in financial outcomes. And these are really financial outcomes for people. You need excellent investment products, but you also need data and technology to understand how to use those investments and where they fit into the full portfolio. I know, Bill, you've done quite a lot on the total portfolio approach of institutions and even for individuals, so that all these different pieces talk to each other in the portfolio. And then finally, you need outreach, which sometimes for an individual investor, it still has to be rigorous, but it's a form of marketing. And then to large institutions, it's really about strategic partnerships. And I think many firms do one or two of these well, but BlackRock, this was a chance to really do all three. So a couple of days later, I met our CEO and the other president, Larry Fink and Rob Capito, respectfully, and I couldn't resist. I really wanted to make a difference. So I joined BlackRock and now I'm a recovering academic, but investment practitioner.
And I'm sure many of those skills are transferable. So thanks for that, Andrew. And without exception, when I've had guests on and they give their background, it opens maybe an unexpected door that gets us back to the subject matter at hand. And I'm not at all going to ask you to comment on Norway's sovereign wealth fund, but using that as maybe a lever. They were in the news the last month or so, and $1.6 trillion in the process of putting 5% or asking the sovereign to go 5% into the public markets, which is about $80 billion, a big sum of money. So again, those are facts that have been reported in the paper. I'm not asking you to violate any past or maybe even current relationship with Norway. But as you think about this whole trend toward democratization, and even the big institutions are saying, hey, the 60-40 is not really doing it for me more, and I need to have greater access to the private markets. And we see a lot of big institutions up their ante under what is strategic asset allocation. We'll come back to the big fat pitch you threw me on TPA in a moment. But maybe dialing this back to a question, if I think about accessing the private markets, is it correct to think about that through a factor lens? Because maybe it's a little bit of a size factor, maybe a little bit of a risk factor, but I would almost argue equity risk premia is equity risk premia, and it doesn't know if it's in the private or public variable.
I completely agree with that. Just putting the word private in front of equity doesn't make it completely different. And there is a large amount of overlap with public equity. But there is something unique about that. And I think factors here are absolutely essential to think about how these different things work in a portfolio. It really is the language of how a portfolio can work together. And I think you've alluded to these things already, Bill. But there's first this democratization, that we have a lot of these institutional investment strategies that are now available for individuals. And that includes these traditional factors: value, quality, momentum, minimum volatility, searching for smaller, more nimble securities with low size. So we see that in public markets, but we've also seen a democratization of taking private market investment strategies and making those available for individuals as well. And that's all being really beneficial for individuals' portfolios. The second and third things are, I think you should know what you own. Really lends itself to looking at things through a factor lens. We want to understand that both public and private equity will do well when underlying economic growth is good. When we enter a recession, both of these things will potentially underperform. But we need to understand that. And looking at real estate as a bundle of these different factors, real estate is a great example because it's bond-like in that properties give us rents. But these properties tend to perform better when the underlying economy is also good. So there's both equity and bond-like components of real estate. So understanding what's really behind this allows you to mix and match and put all of these pieces together into an optimal portfolio. If we don't do that, then sometimes we will have these unintended exposures and then be subject to these very large drawdowns. And the third principle is, I think you should ensure what you're getting is what you're actually paying for, right? And in the public markets, we have a lot of these alpha, but it's alpha really masquerading as index or market exposure or factor exposures. If we're really after high conviction active, well, they should be getting us a return in excess of a market benchmark and these well understood intuitive factor exposures. In private markets, this is absolutely essential. These are areas which are very opaque. By definition, you can't easily trade them. The transaction costs are enormous. And then we have a lot of information asymmetry between the actual provider of the capital, which is me and you, and the managers of that capital. And so really understand that we can actually put that money to work in a public market setting. So if we're really putting money in private, we should get a return in excess of what we could easily do in public markets. I believe there is a premium there, but like any alpha in public markets or alpha in private markets, it does require skill and it can be quite hard to find. Democratization of all these investment strategies, we should know what we own and therefore be able to put them together in an optimal way. And we really need to get what we actually pay for.
Yeah, so a couple of very interesting things. And I wrote down, I think of everything you said, it was all very interesting. Four most important words: know what you own. And I think you really do have to be compensated for the risks you're taking. And if you're buying alpha, you should know where it's coming from and recognize that it may take full market cycles to recognize it's sometimes out of favor, but you should be willing to pay up for that. Versus pure beta, you should be willing to pay very little on the flip side. And I think here's some of both the opportunity and challenges, Andrew. And if you say to me, Bill, tell me about your investment portfolio. And if I say 60% equity, 40% bonds, that's not enough information. And where is my equity exposure? Is it sector dependent? Is it capitalization dependent? Is it in a more volatile aspect of the equity markets? And now when the narrative is moving toward democratization, to say you should have 30% in alternatives, I'm not sure what that means. You should have 20% in private equity. I'm not sure what that means either, because these are very complex industries with their own drivers of value, with their own factors. And maybe I do wonder, maybe we've seen this play out in the public equity markets where the dispersion is a lot tighter, but all public equity is not created equal. And do we run the risk that investors are thinking too much about an asset class like private debt, like real estate, like infrastructure, like private equity, as opposed to really either themselves or through an agent like BlackRock or an RIA, if they're helping me, getting really to the sort of the bottom line as to how am I being compensated for the risk I'm taking, and do I know what I own?
That, I think, is the essence and the really true function of investors and advisors, as really to help in answering this question. I think the factors being the language of these portfolios and making these different pieces or these silos or these asset classes talk to each other, that's where really these factors have a lot of power. Because as you said, it's not just about 60-40, it's really 2 or 3 steps more detailed than that. Now, let me start off by saying that I think these asset classes are important. They're well-defined categories. There's expertise in each of these areas, and we've grown up for industries that are organized around these. But we do need to look through. We need to look through a label on a fund or even the fund type to really what drives the returns. Now, I think we should start off just with owning the market. Equities and bonds are a very convenient and extremely low-cost option for us to remain invested in the 2 most important investment exposures that we can get. Starting off with index, it's starting off like being average. And actually, I wish I were average. I'm a pretty short person. I'm 163 centimeters on a good day. And I actually wish I were average. It would allow me to be able to buy more clothes off the rack. There's absolutely nothing wrong with being average. But sometimes being average is not enough. You might need a little bit more defense in your portfolio. You might be able to take on a little bit more incremental risk and have higher returns. But starting with averages is not a bad thing. And that's where after going from index, you can then think about moving to factors, very intuitive, economically based. We've got hundreds of years of empirical evidence, 6 Nobel Prizes. We have tens of thousands of papers in these areas. Now, the factors aren't rewarded always unconditionally. There's cyclicality in there. And perhaps if we have time, we can talk about some of these investment cycles and maybe how to time these factors in public markets. But they give us a basis. They come out from economic theory. There's a reward for bearing risk. They result from structural impediments, or like momentum, they can result from investors' behavioral biases. But over the long run, we would like exposure to that. And that's actually where I participated in a major report to the Norwegian Sovereign Wealth Fund after the 2008 global financial crisis, where actually Norway had these factor exposures. They were actually doing the right thing. They had exposures to value. They had exposures to quality. But sometimes these things draw down. Over the long run, they're rewarded, but there is some cyclicality. And I think with Norway, all of these things were actually going the right way. There are positive exposures to these regarded well-known sources of returns, but they weren't communicated or they weren't widely known. And I think if they were, then we would understand sometimes that losses can happen. And so the Norwegian Wealth Fund now reports on all of those exposures in a much more comprehensive way than before. And all that information, it's knowing about what exposures you have. And then finally, we can go from index to factors, and then finally to alpha. But alpha, it's uncertain. Sometimes it's hard to find. And if you are able to find these managers, if you do have the resources, if you are able to take that risk, then you can shift some of that index and factor exposure to these alpha sources. And I have some papers that actually look at optimal combinations of index factors and alpha altogether. Switching now to private markets, we actually have to know the public exposures behind those private markets. And that unique portion, the unique portion of private equity beyond public equity, or the unique portion of infrastructure and real estate beyond the plain vanilla equities and bonds, that's really valuable. But we have to identify that and we have to evaluate and monitor that. But if we can, using that language of factors, that allows us now an incredible investment opportunity beyond these public market exposures. But we have to push into those areas and really identify what's unique about them to understand them for us to be able to hold them in a portfolio.
A couple of things about owning the market, and I want to start public and then go to private, Andrew. So owning the market, and again, nothing on this podcast is investment advice. So I just want to make that clear and put you in a comfortable spot because people would care more about what you had to say than I. But if I think about owning the market in a cap-weighted index like the S&P 500, I probably am overweighted certain factors than not. And while I may be of average height, maybe above average weight, so it doesn't help me at the clothing rack. So stretching that analogy, so to speak. So is there an optimal way of owning the public equity markets beyond a cap-weighted index?
I would start with cap weighted, as I said before. There's nothing wrong with being average. And for most people, that's sufficient. Once you start from there, you might use some factors in the following way. So perhaps you want more resilient, robust portfolios, particularly during these downturns. And then you should upweight some of these defensive factors like quality or minimum volatility. We're actually overweight both of those factors in our time-varying factor rotation models today. If you're able to take on a little bit more risk, then we can hold some more of the pro-cyclical factors, things like momentum or value or size. And that, I think, is a good basis to start. But for most people, the market is absolutely sufficient. Now, you raised a really interesting question that we addressed in a paper, What's in Your Benchmark? And that paper was published in the Journal of Portfolio Management. And it's a factor analysis of major market indices. And it turns out that the factors, say in the US, like the S&P 500, are not the same factor exposures that we see in Europe or in Asia. So all of these factors we do observe, in fact, by the definition of factors, that these are broad and persistent drivers of return. We observe them in many different asset classes and many geographies. But the makeup of those indices, they contain different factor exposures across these different regions. And there are some interesting things. So perhaps as expected, in the United States, there's a lot more momentum. You might think about stereotypes of a gung-ho cowboy or very risk tolerant, able to weather all types of losses quite easily. And in Asia, in certain markets like Japan or China, we actually see very little momentum exposure, and sometimes it even goes the wrong way. Europe tends to have a lot more quality across these different regions. And then we have Asia, which generally tends to have more value. But yeah, exactly like this, if we were to actually go and look at these major market indices, these major market indices are quite different. And dispersion is a fact of life. Today, we actually don't think about the S&P 500 versus the Russell 1000 or the Russell 3000 or the MSCI USA, but they are actually different. And there is dispersion between them. That dispersion is just orders of magnitude larger in private markets, where actually these indices really aren't available at all. But we do accept that making these investments in private markets comes with dispersion. I just want to make the point that actually that dispersion also exists, to a lesser degree, of course, in public market investments too.
So just one follow-up on that then, Andrew. So if I want to own the market, I very much understand your point that if I went out and bought a series of indices globally, I may end up canceling out some of the diversification benefit I sought in the first place or being over or underexposed. Would one approach be to go and buy the All Country World Index and be done with it? Or are you better off being average in the US, which is the dominant market, and then say I've got my equity beta box checked?
Yeah, that's a great question because the US has had superior returns over the last couple of decades relative to other developed markets and certainly absolutely relative to emerging markets. And how you cut your portfolio, right, US versus international, in the bulk of the paradigm that we have for the Morningstar Starbucks frameworks, or we do developed markets versus EM, and it does make a difference. I think where the country is that you live, your liabilities are denominated in that currency, your spending occurs in that currency. I think there does actually deserve to be some home bias in that. So that could be Canada versus the rest of the world, or United States versus the rest of the world if you're a resident of Canada or the US. Now, after that, I think we should pivot to where the best investment opportunities lie in terms of a global portfolio. But the home country, I think that deserves some special attention.
And then just turning now to the private markets, and maybe this is a little bit theoretical and borderline dreamy, Andrew, but is there ever a scenario, and I assume maybe even in our lifetime this will be true, where as a private investor, I can quote unquote own the market, where there's a index that can replicate maybe the median returns in private equity, which some could argue, if you look at it through the lens of IRR in the private markets versus cash on cash return in the mutual fund land, maybe they're not that different, but most studies will show there's maybe a 200 to 300 basis point pickup. So if you could get that, I doubt it's going to be given away for 1 or 2 basis points, but if you could buy that beta, I think for the average investor, that would be an awesome way of just getting that exposure versus trying to go through all the paces to find the right manager in that top quartile. I just think that might be too big of a mountain. So can you envision having an own the market type of investable index in the private markets?
I think actually the research for that, it's already here. And that's research by myself and co-authors plus a fairly large number of academics. And they basically show that the amount of explanatory power for private market returns, it's pretty high if we were to take public return proxies. So we're talking about private equity before. Private equity, you want to take some leverage to the public equity, or at least hold the smaller stocks in that universe. And they usually have some value tilt and a high quality tilt as well. And you can go pretty far. But I would say that what's missing yet are very broad-based parallels to the index fund that really revolutionize public market investing. We haven't seen that yet for private market investing. Now, I still think that there's benefit from an actual private market investment, say, versus these public market proxies. But in fact, that's the whole reason. That unique component is the whole reason why we would want to invest in something that's extraordinarily expensive with huge information asymmetry, that's very liquid with enormous transaction costs. It's that we want that unique component. But we have to be able to identify that unique component relative to what we can get almost essentially for free in the public markets.
Somebody you might know, Randy Cohen at HBS, he's been a guest on this program late last year.
Well, Randy Cohen is one of those academics who have been really pushing. He would actually completely agree with us that a large degree of these private market returns you can actually get already in public markets.
And I think it's a pretty clever approach. Whether or not it continues to get legs, we'll see. But I think he's very quick to point out that it's still maybe early days to some degree. And this could be, if nothing else, a good way to get exposure for uncalled capital, as an example, where you can at least replicate some portion of it. But it looks like there's been some innovation. And I firmly believe that if we can get this democratization right to a very large degree, it has to be very much focused on better outcomes, not necessarily on more product. But if we could find ways of just getting investors exposure to uncorrelated risk premia, in the private markets, be it real estate, infrastructure, privates, the world will be a much better place. So maybe a couple other things I did want to cover, Andrew. I think early on in this conversation, you mentioned what I think was 5 factors of value, quality, momentum, size, and volatility. Are those the big 5? Were the ones 3 and maybe 7 and now down to 5? Has it always been 5? And I want to lead toward the other AI, artificial intelligence, in a moment, but I'll tuck that, but maybe that's part of your answer. But how many factors are there that you focus on?
5. Now, you might want to add a few more that these factors, you have to have impeccable economic rationales. You want to have really long time series of data. They should be lowly correlated and have differentiated returns, particularly with respect to these market cap benchmarks. And you have to be able to do it at scale. And maybe it's useful to maybe give some examples that don't fulfill these criteria. One example is liquidity. Now, there is a liquidity premium. Now, by liquidity premium, you take illiquid securities, relatively speaking, in the liquid public markets, not the illiquidity premium in private markets, which is really a statement about alpha. You don't get paid just because an investment is illiquid per se. You get paid because there's uncertainty about that alpha. This is hard to scale. By definition, these liquid securities are hard to trade. And so for me, that doesn't make it a universal factor that applies broadly. And there's a well-known academic study that shows that there's a positive relationship between volume and returns. And some quant models, in fact, we treat that as an alpha source. But the relationship economically is a little bit perverse because you would think that the more liquid a security is, the lower the expected return should be. Or put another way, if it's harder to trade, well, that's bad. You need a risk premium to get that. And this operates the opposite way. So it's actually a perverse relationship. I don't think it should be a part of a factor offering, but potentially it may serve as some alpha strategy in perhaps an alternative or alpha seeking part of your portfolio. So all of these factors, they're due to this economic rationale. And I want to comment on 2 in particular, size and value. So size, there's been quite some debate on, but small stocks do have higher returns. And if you look at French's data, and he's done such a service to the profession putting out all of that data, and you just look at these stocks sorted by size into deciles, small stocks do have higher returns. And it's pretty consistent in the various decades. Now, small stocks should have higher returns because they're riskier. They're more liquid. They default more. Information transmission isn't as efficient in this part of the market. And in one example that they have higher risk is that they have higher betas. So if you look at small stocks minus the market, yes, these stocks have higher returns, but it's mostly due to them having a higher beta. Small minus, say, 1.2 times the market, the alpha's actually equal to 0. Now, why is this premium there? It's due to this reward for bearing risk. In fact, the most basic type of risk from the CAPM, which is beta risk. It makes sense for a long-only investor to consider the size premium. You are actually deviating from the market, particularly to bear that risk in some search for higher returns. Size should be considered. Value is another one, and value's had just a roller coaster of returns. It really started underperforming in 2018. So we saw poor returns in 2018 to 2019. And that's actually consistent economically because we were in late cycle. The best time for value is early in the cycle. Think about a company with a lot of physical capital. Late in the cycle, you'd really like your factory to produce another widget, but it just doesn't. And so that inflexibility leads to underperformance. And that's investment-based asset pricing theory in the finance literature. Then 2020 came along, and that was just horrific. And in short, companies with a lot of physical capital, they require physical interactions, and we just didn't have any. The turning point was at the end of 2020. In fact, you can look at the data, and it's really November 2020, which coincides with the announcement of the first effective vaccine against COVID. And now markets are forward looking. We start to see a path towards normalcy and recovery. And as the economy opened up in 21 and 2022, that's the early part of the cycle, value firms decisively beat growth in those 2 years. They pulled back a bit, really due to the rise of AI, with ChatGPT being released at the end of 2022. But we're still, at this moment, recording this in April, we're still at 20% below peak that we started in this. But this is cyclicality. We receive a long-run premium to compensate us for this short-term cyclicality. But yes, I do believe there is a value premium. Now, we want research to think about more efficient ways to capture each of these premiums, to trade more efficiently. And that's where I think all the research should go.
Just follow up on that. I'm going to come back to AI, but I want to talk about smart beta in a second too. But coming out of 2022, the big storyline was look at where the public equity markets drew down 20% minus, to put it in a round number, and the private proxy was flat. And then the denominator effect took hold, and many people ridiculing the private equity model, and some coming out in defense of it, some saying things, volatility laundering, et cetera. But I don't know if there was a house view by BlackRock. I imagine there was, but I did see something Howard Marks wrote on the subject. And he talked about the difference between owning a company versus owning a stock. And then I don't know if he referenced it here, but I've always been a big consumer of Graham and Dodd, and Benjamin Graham that said the public markets are a voting machine short term, weighing machine long term. So there is going to be, by essence, price smoothing. And I think we talked right before we came on about equity doesn't have a heart, mind, or a soul. It doesn't know if it's private or public. So I think over time, equity risk premium is equity risk premium inside of public or private. And I would argue the benefit of the private markets, as you just said a moment ago, is the lack of efficiency and to be able to get in there and extract value versus a very efficient public market, albeit maybe it's less efficient through the lens of some of these factors. But maybe some of your thoughts on that broad thesis. I don't know if there's a question in there or not.
That's absolutely right. Let's flip this question around. I talked about these private markets are really hard to trade. They're expensive. They're, by definition, illiquid in this very large information asymmetry. And if you were to flip that around and say, if you had talent, if you could generate alpha, would you rather apply that alpha in markets that are easy to trade, that information is disseminated extremely efficiently, that the fund structures have very good governance controls and monitoring? Or would you rather that in these private markets that are exactly opposite? Of course, where there are these information barriers, that's where the real opportunities for alpha lie. But to identify them, you've really got to know what you own. And let's not make the mistake. The opportunity cost of $1 in the private markets is you could be earning bond and equity risk premium essentially for free, another part of your portfolio.
Appreciate the thoughts on that. So maybe a good spot to finish is maybe a slightly deeper dive on the other AI, artificial intelligence. And we spoke a little bit about it before we hit the record button, but we talked more about this at breakfast too, about how you and the industry as a whole are really starting to use, and maybe more than start when it comes to BlackRock, all of this, all data. And I don't know if that in and of itself is a risk factor, or maybe it's a subset of the big five, but I don't know if anything's any different. It's that there's more data to be crunched, more unstructured data that you can now get a handle on, turn words into data, and it gives you insights that you may not have had just a handful of years ago. How excited are you about the opportunity set of artificial intelligence and how you're deploying that through the work you're doing? And are we still just in the early stages, more toward maturity, or somewhere in between?
Well, I want to say, first of all, that the whole history of factor investing, and you started off with Graham and Dodd's book in 1934, Security Analysis. And that book really was the big data and machine learning, or AI, of the time. All of these data sets, financial data sets, you had to actually go collect. There were no standardized reporting. It was actually alternative data, or big data at the time. Graham and Dodd proposed that you should actually treat this alternative data systematically to come up with a valuation for a firm. You compare its current prices in markets relative to a systematic way of valuing that company. And that we actually used an algorithm. They proposed an algorithm to actually help us do that. So factor investing has long been on the forefront of using these alternative big data sources and using those in a systematic fashion with machines. We fast forward to the 1980s, where we could actually start to use computers with this. And now we have the latest incarnation with unstructured data sets and now these generative AI models. We've applied these generative AI models so far at BlackRock to estimate sentiment. It's a really natural way to do this because they have comparative advantages with text. And you can actually do this with multiple languages, not with just the major languages. We've also applied it to identify thematic baskets. These generative AI models are very good at summarizing disparate amounts of information and then extracting these themes. And we can actually create baskets from them in a systematic way. So I think these is just the latest incarnation. But we've always, I think, as factor investors, been on the forefront of wanting to use the most efficient techniques and the latest data sets. There is alpha, I think, in these, but over time, any alpha really is transient. The things that remain because of this economic foundation. There are investors that just can't tolerate certain losses in a cycle. We are constrained sometimes in the portfolios we can hold, giving rise to, say, minimum volatility premium. Or I think investors, even with all this big data and machines, investors are going to be investors, and we're going to always have these investor behavioral biases. So momentum and all of its effects will always be with us. However, we can estimate some of that sentiment giving rise to momentum in more efficient and better ways.
Just one follow-up on that, Andrew, and then I'll let you take care of your clients, which is what you're paid to do. In the good old days, and I spent a good chunk of my career in the asset management space, when you had a new idea, a new thought process, the very first thing, you'd get the smart PhDs to run a back test on it. Can you run a back test on alt data? I guess maybe it existed in some form, but are these types of alt data-based products and approaches, are they subject to a wholesome back test?
Yeah, this is actually a problem with some of the latest generative AI models, is they are not strictly point in time. Now, we are fortunate that, say, if you use GPT 3.5 or ChatGPT, that's actually been snapshotted with data prior to its release in the end of 2022. So that actually can serve as an out-of-sample exercise. But partially because of these, I think our preference is to fine-tune our own proprietary large language models. We base these on open source, but now we are able to fine-tune them using data only available up to a point in time. We won't remove entirely these concerns, but it does mitigate it to some extent. But this is actually a major problem. But it turns out that this is actually the same problem that we have for most data. Economic data, which is released by government agencies about GDP or inflation, most of that economic data is revised. Again, it's very hard to take vintage point-in-time data for that as well. So this concern, yes, it's absolutely a concern with a lot of unstructured alternative data sets, but it's a concern that quants have always been aware of and have different methods of dealing with.
I think that falls under the adage, the more things change, the more they stay the same, perhaps. And maybe the quants have suffered from that more so than most. But great discussion, Andrew. And maybe some of these papers, I think JPM might be behind a paywall. But if some of these papers are in the public domain, I'll link them when we release this. But enlightening to me, I think to our listeners as well, in a space that I think people should pay more attention to. Thanks for your time and your input. I enjoyed it.
Thank you very much, Bill. Pleasure to be here.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.